The Blockstream app is your gateway to financial freedom on Bitcoin. Built by the team behind more than a decade of Bitcoin innovation, it's the easiest way to buy, secure, and manage your Bitcoin. Download the Blockstream app and start stacking straight to self-custody today. The future of finance runs on Bitcoin.
Matt, welcome to the show.
Jesse, thanks for having me.
Great. Maybe to start off with, we can start with your background and your path to Bitcoin.
Sure. I started as a journalist covering finance at Bloomberg, CNBC, some other outlets, and realized pretty on the phenomenon of fake news. Just as you know, the logistical challenges of getting audio and video and print on the paper, which is what used to happen back when I was a journalist, can kind of overwhelm the time spent actually searching for the truth. So I got pretty disillusioned with media, envious of my sources who had more zeros next to their personal balance sheets, and started studying for the CFA and eventually networked my way into finance on the buy side. And I spent 5 years working for Cathie Wood before she started ARK. So this is in the Alliance Bernstein days, covering tech. And we were big investors in the Web2 platforms, recognized early the kind of winner-take-all characteristics of that space and the margin potential. But we were always open to the idea that open source software could disrupt some of these walled garden ecosystems. We were, buying. I remember buying Korean gaming companies when they had their first kind of virtual item efforts, and I wasn't there when Bitcoin was invented, but we were kind of primed for it. So I then spent 10 years working at an investment bank, Hong Kong-based investment bank that was eventually acquired by a Chinese state-owned entity, and I was writing strategy for them. And I kind of felt the same issues that I did in journalism, which is, we got acquired by this Communist Party organization, and the self-censorship kicked in, and just started to get more conviction that Bitcoin, with its consistency, predictability, was going to be more appealing to more people as kind of the demographics changed. So left investment banking in 2021 and have been at VanEck's for 4 years, building products and conviction here.
That's amazing. So there actually were journalists that were writing about Bitcoin in the past and actually bought some and made some money on it. I didn't think that they existed.
Well, I mean, I left journalism in 2007, so this is all pre-Bitcoin days, right? But I did, part of my investment thesis in the early days. I first bought in 2017, and it was really like an anti-Google thesis. I remember writing this research piece called "Google is Evil" that went through all of the kind of natural monopoly features that the company had, and my conclusion at the end of the piece was buy Google. But I also I timestamped my first Bitcoin purchase and said, this will be the technology that eventually takes margin away from some of these closed source walled garden software, which includes the banking system, but also includes some of the Web2 giants. And I think that thesis is starting to play out.
Why do you think so many journalists? So I remember, 2016, 2017, a lot of those journalists that were writing about Bitcoin, they're still writing about it today, about how failure is imminent. They don't seem to have got it. Why do you think so many people who I think are probably pretty smart, it just never clicked with them? And they've been covering it for like a decade.
Yeah, it's amazing. I think there's many reasons. One of them is groupthink, simply put. Culture of kind of skepticism. You'll see most journalists tend to write negative articles rather than positive articles. I mean, they've been negative on big tech the whole way up too, right? When you think about it. And that's because Google literally ate all of the local advertising market. So there was this existential business threat from the technology itself. And I think that might have colored some of the editorial process as well. But I still talk to, my old colleagues at Bloomberg, and they're not even allowed to own crypto. So it's hard to get bullish when you can't really touch the technology. I think it's kind of like a time capsule in the traditional media.
Yeah. So what was it about Bitcoin that clicked with you?
Yeah, I find that most people come at it either from an engineering perspective, like a
Mhm.
fascination with cryptography or the underlying computer code, or from a financial/economic perspective. Mine was definitely the latter. Just, personally revolted by the money printing of 2009, 2011, et cetera. So, I was working for this Asia-based investment bank and traveling a lot around Southeast Asia. And I remember talking to regular people, taxi drivers, et cetera, who were bringing up Bitcoin, and took that back to my colleagues on the trading desk in New York. They said, taxi drivers are talking about it. That's a sell signal, man. And I said, no, I think this one's different. This is a retail driven phenomenon. Like, the investment bankers are going to be the last ones to be talking about it. And I think about it, my mental model is the way that the video game industry evolved, where 30 years ago, there weren't too many 50-year-olds playing video games. But every 15-year-old was playing video games. And when you look at someone like Elon Musk today in his 50s still playing video games, right? So you don't stop. And yet those 50-year-olds 30 years ago are now dead or dying, still not playing video games, but their grandkids are. And when you look at the surveys, especially in emerging markets, it's the young folks who see Bitcoin as digital gold, future of money, and that demographic tailwind is just incredibly powerful. So, and I think it's more relevant to non-Americans. So I was fortunate to be working for a Asia-based company that, for the citizens there just feel that Bitcoin is more relevant. They don't have dollars, they can't get dollars. So I think as an emerging markets focused person, that it was easier for me to grasp it.
Yeah, I think that's my sense too. I mean, I'm based in Asia as well. I'm in Taiwan right now. Been here for 25 years. And it was kind of the same thing with Tether actually as well, where you'd see English Twitter would be just tearing up Tether all the time. But people in Asia were just using it. They didn't even know what it was. They're just, oh, it's not, it's not from the US government. They had no idea. It's a tool that worked and people were going to use it until it didn't work. And then they would find something else. So yeah, I've always found that really interesting. I think it's less so now, but I think, well, maybe it is still exists maybe there is a pretty big geographic split between how people look at and use Bitcoin and Tether in different parts of the world. Maybe I think that probably still does exist, probably.
Yeah, the survey work that I've seen, even recent, just very simply, it asks people in like 20 different countries, are you optimistic or pessimistic about Bitcoin? And the most pessimistic countries are like Japan, France, Italy,
Hmm.
basically old countries full of old people with
Yeah.
terrible demographics. And then the most positive, optimistic countries, Vietnam, Philippines, Nigeria, like these are some of the youngest countries in the world, and those whose currencies have been particularly weak over the last few decades. So it
Yeah.
feels still to me like that thesis still holds, that the ETF maybe unlocked some of the speculative use cases for Western investors, both retail and institutional. But if you're talking about the fundamental use case of touching the coins, withdrawing them to self-custody, sending them peer-to-peer, it's more relevant for emerging markets still. I think it'll remain that way for some time.
Yeah, if you look at kind of sell side research or kind of how it looks like Wall Street is looking at Bitcoin, like I don't think I've got the white paper behind me. I don't think they've got the peer-to-peer digital cash thing on their roadmap at all, do they? I was going to ask you about this. So I guess in the first half of the last cycle, we had a lot of institutional players were comparing Bitcoin to gold as like a debasement hedge, right? So we had Paul Tudor Jones, he called it the fastest horse. We had JP Morgan, they had that. This is actually a Bloomberg headline. It was one of my favorites of all time. It said that Bitcoin will make gold suffer for years. It was a great headline. But by the end of the cycle, I think most people were looking at as the ultimate risk-on asset. So how do you think that? How are institutional people looking at it today? Is it as a hedge like gold, or is it an easy money kind of speculative asset?
I think most institutional investors use the digital gold analogy, but They also are more careful about position sizes because of the volatility of the asset and because of its high correlation in recent years to NASDAQ. We like to say that Bitcoin is a chameleon. The correlations change over time. There's been several years here with an elevated correlation to NASDAQ and risk assets, but over the last 15 years, you can't really say that. And the most persistent and consistent correlation that Bitcoin has been a negative one with the US dollar. So that it shares with commodities and gold. And we think that makes intuitive sense. One of the interesting things just about the last couple months is that when you look at it on a daily basis, Bitcoin's correlation with NASDAQ and S&P still remains pretty high relative to its history, and yet we're all talking about decoupling, Bitcoin outperforming during the kind of tariff uncertainty. So that's a peculiar dynamic here where daily correlation is still high, but the absolute returns have diverged, and the downside capture of Bitcoin has been, has basically been erased. Like on those big NASDAQ down days, Bitcoin wasn't going down nearly as much, even though it was directionally moving in the same direction. I think there's a long way of saying that although Bitcoin is consistent in its block times and other aspects, its correlations move around.
Yeah, I guess that's a big part of that is how the investor base has changed so much over the last 10 years. So it was kind of like a unique asset 10 years ago, and then it was just completely retail. And the institutional money is kind of later to the game. So I guess that kind of changes the correlation with other assets.
Yeah, I think that's fair.
And so how do you see it performing versus gold over time? I guess, the demographic argument that you made earlier is probably supportive of it taking market share from gold over time.
Yeah, that's our call. So VanEck has a lot of history in the gold markets. We've been around since 1955, and our first flagship fund was a mutual fund, international mutual fund, so non-U.S. equities, and the PM of that fund, who's also the founder of VanEck, in the late 60s got conviction that inflation was going to reaccelerate and that the gold peg was at risk, and he pivoted that fund almost entirely into gold miners, which was a bit of style drift at the time, but it led to VanEck Gold Shares, which was the best performing mutual fund in the 1970s, and we've been kind of hard money folks, macro folks for many decades, and identified that Bitcoin could become a competitor, certainly a collaborator, but also a competitor to gold over the long run. And so began to deploy some of our gold and gold shares profits into Bitcoin 2017 on the firm's balance sheet. This is before the regulator would allow Bitcoin products. And we see them as complementary. You could see it from earlier this year. They tend to take turns leading the market. And they do have very different volatility profiles. If you're weighting a gold Bitcoin only portfolio, it might be still 70% gold just because of the lower volatility. But I think it's too early for Bitcoin to really call it it's a smaller asset, and that's why it's more volatile. And there's a lot of advantages of gold over Bitcoin, specifically the ease of transferability. I noticed that Argentina just had to charter a jumbo jet to fly their gold up to New York so that we could certify it as real. So that's tens of millions of dollars just to be able to use your gold as collateral. So Bitcoin has some advantages in that regard, but it's a smaller asset class, so I think that's why it's more volatile.
And you guys were also one of the first to get a Bitcoin ETF as well.
Yeah, we were the first traditional mutual fund sponsor to file for a Bitcoin ETF in 2017. Obviously all of the ETFs came to market at the same time because of the way that the Gary Gensler SEC treated these applications. But there's a lot of internal conviction. It's a privately held firm, and we own 10% of the shares outstanding of our own Bitcoin ETF, which none of the other sponsors can claim that level of ownership. So that's
Show
how
some
we try to
conviction.
pitch. It's skin in the game. We like to,
Yeah.
cook some yummy food over here, and then we eat it ourselves pretty aggressively.
Yeah, that's good. And how has, like, what are you seeing in terms of investors into the ETF? Has that kind of cohort of investors changed over time, or is it expanding into new investors, or is it fairly constant?
In the aggregate, if we look at all of the 10 Bitcoin ETFs, what we've seen over the last year is more adoption by the advisor community. So money managers, essentially. So in the early quarters, it was mostly hedge funds. Hedge funds ownership of the Bitcoin ETFs was more than 2 to 1 the advisor community. And I think that had to do with the attractiveness of the basis trade, using Bitcoin futures and Bitcoin ETFs to try to capture that upward sloping futures curve. But over the last couple quarters, it's been more of these registered investment advisors, and now, according to the Bloomberg data, their ownership of Bitcoin ETFs actually exceeds that of hedge funds. So that's been, pretty encouraging to observe, kind of a longer-term holder community that's been coming in. For us, we are, I think our clients are more on the retail and the advisor side from the beginning. I saw some interesting data when Bitcoin had its drawdown in Q1. It showed like what among all the ETFs who had the smallest or biggest drawdown of Bitcoin held, and we were second to BlackRock in terms of this small drawdown. Most of our clients are kind of long-term believers, and we don't have the same volatility that some of the other sponsors have.
Yeah, interesting. You also have an on-chain economy ETF that looks at Bitcoin infrastructure companies.
Yeah, this one is very close to my heart, as I'm the manager of that one, and I guess the number one pushback that I still get from talking to institutional participants is Bitcoin's volatility. And they may believe in, the asset kind of theoretically, but they want to be able to sell something in a year or two without worrying about a 60 or 70% drawdown. And when you look at the equities in the space, there's a bunch of pure play equity ETFs. We run one as well. The volatility of those underlying stocks, the Bitcoin miners, the MicroStrategies, is more than 2x that of Bitcoin. And the long-term returns have not been good because many of these companies took on debt last cycle, and debt and Bitcoin are pretty toxic. So there was a lot of bankruptcies, and they are not only the leverage, but a lot of dilution in the space. That it's almost like the altcoin to Bitcoin comparison is like altcoins are to Bitcoin what Bitcoin equities are to Bitcoin as well. And like once the price goes up, the management teams tend to issue a lot of new shares, and you get these big gaps between market cap and price. So that's not a very comfortable position for an equity manager. So the idea of this fund is to try to smooth out some of the volatility in the space by taking a broader approach as to what it means to participate in the on-chain economy. So in our investment universe, of course, there's pure plays like miners and Bitcoin treasury companies and Coinbase, but also those companies across other industries that are increasingly calling out Bitcoin and digital assets as a driver of their end markets. Maybe they're saving money from crypto or Bitcoin. Maybe they're kind of a provider or a service provider to some of the Bitcoin miners. So by doing that, we can have a much broader investment universe that includes things like utilities, energy pipeline companies, fintech, some of the market makers, traditional market makers that have both traditional securities and crypto businesses. And the long-term performance of this investment universe, at least according to the backtesting, is far superior to the pure plays on a kind of risk-adjusted basis.
So these are maybe more traditional companies with kind of like a different core business and independent revenue streams, and then the Bitcoin component is kind of a kicker on it. Is that right?
Yeah, I think that's the right way to look at it. So we can own crypto ETFs in this fund up to a 25% weight. So our largest position is our own Bitcoin ETFs. We do hold Bitcoin miners and Coinbase and MicroStrategy, some of the MicroStrategy capital stack, but to complement that very high volatility pure play component, we also include some of this ballast, the lower vol fintechs, utilities, market making side, and that's set up to give us spare powder so that if and when there is a washout in the Bitcoin price, we can deploy some of these lower volatility positions into the pure plays, and the risk reward probably will be better than launching into like a fully deployed high beta portfolio right as Bitcoin is at all-time highs.
And what do you think about the prospects for a washout? Do you think that's something that'll still happen? I think there's different views on how the 4-year cycle will play out now. But, I was one of these people in the last cycle who thought that we had enough institutional participation that we'd have a little yin to the yang and we wouldn't see the big pullbacks. And then we saw another big pullback. So do you think that will change in this cycle, or are we still going to have big washouts periodically?
I still am prepared for washouts. The types, some of this can be self-reinforcing. So when you look at what's working in MicroStrategy's favor right now, strong Bitcoin price, volatile stock leads to demand for their convertible bonds and this type of arbitrage situation, and allows them to issue equity at a premium and buy Bitcoin. But if Bitcoin's in a bear market or volatility is falling, I know Saylor's promising not to sell, but not all of these Bitcoin treasury companies are promising not to sell. And one of the ways that they can kind of preserve shareholder value is going to be selling Bitcoin and buying back stock in a bear market. So I still think it's, quite immature asset class with a number of low conviction holders. And, maybe we don't see the 78% drawdown that we saw last cycle, but I think investors should still be very prepared for 50% drawdowns, particularly in periods where Fed is tightening and other risk assets are weak. And that's where I see this new fund is giving us the potential to smooth out that process.
And what about, so, my day job is head of operations at Bitfinex Securities, and we do security tokens and RWA assets. We have a platform for that. Are you guys looking at tokenized securities at all, and maybe the possibility of including those into your ETFs?
It's possible. We're definitely looking at tokenized securities. We just launched in the last quarter the VanEck's tokenized money market fund called VBill, which is available across half a dozen different blockchains, and it's tied to a stable coin that we're backing called Agora AUSD, so that investors can mint and redeem VBill for Agora 365 24/7 in one click on the weekends. VBill has much lower minimums than BlackRock's BIDL fund, so 100K minimum. I think BIDL is over 1 million or 5 million or something like that. So you should see some announcements over the next few months as to customers, exchanges that are going to be using this mechanism for weekend settlement internally. And I think VBill provides a template for us to potentially roll out riskier offerings, right? So we have 100 different ETFs across fixed income, equities. As we see demand from partners and customers, I think you'll see some of those trickle out in tokenized form. But for me personally, we're in this for money, making money, and the number go up technology. And on the tokenized securities side, that I think it's a little bit less compelling than just buying Bitcoin or participating in some of these equity opportunities. It's so fragmented, no real single place for liquidity, and that means that it's hard to make money. So in our venture strategies, we're backing some of the platforms that maybe can consolidate some of this activity. But for now, there's, it's very fragmented.
Yeah, I think probably because it's still very immature, it's still developing. So yeah, the liquidity is very skinny, and I think it's not quite at the platforms like us, I think, are not at the institutional level yet, because you just don't have the size. We can't handle the ticket size that people are looking to allocate into their investments. So I think it's still very early. And then on the other side, when you see what the investment banks are doing, it doesn't really look very much like tokenization. There's not much in the way of disintermediation. There's no integration with Bitcoin and Tether. So yeah, I think we're kind of in still an early phase. I guess it always seems with the security token industry that we're kind of like, a year away from catching on. But I do think that's the direction the market evolves to eventually. Just because I think, the way you trade Bitcoin, and the way you use Tether on Bitcoin exchanges, and the way you've been doing it for like the past 10 years, I think is a vastly a much better user experience for investors, just to have real-time settlement and 24/7 liquidity and stuff like that. I think that's the direction that markets probably have to evolve in eventually. And I think a big part of that is the demographic argument that you mentioned at the beginning. Like, people are going to be used to that. And, my investment banking career was in Taiwan, where we trade, 9 till 1:30. There's no reason for that, right? Like, you should be able to trade on Chinese New Year's, on the weekends, and 24/7. And, news comes out on TSMC and you want to trade it right now. You don't want to trade something else. So yeah, I think that's the way markets evolve eventually.
Yeah, but to your point, like, that experience is a bit independent of Bitcoin. So like, how those two rails connect over time is still ahead of us. Like, you asked if we could hold some of these tokenized securities in our ETF. We use State Street for custody of those securities, and they don't have really a tokenization platform. I couldn't. There'd be a lot of operations work to clear the ETF to hold that type of tokenized security, and whether it's a cold wallet or some type of qualified custodian.
Yeah, there's a lot of momentum in the legacy finance side that I think is very difficult to change. I think that's, my kind of perspective on this stuff is that that's why this is an opportunity for smaller, more nimble kind of places like, El Salvador or wherever it is. And I kind of think that the G7 will kind of struggle a little bit, because they're kind of caught up in the, just the way they've done things in the past, and it's very difficult to change. And the incumbent players have dug very deep moats, and it's difficult to get rid of things like custodians and central depositories. When from a technology perspective, maybe it's not something that's technically required anymore.
Yeah, I agree with that. And that, we often say emerging markets sometimes, skip a generation of technology, skip the fax machine, go straight to email.
Yeah.
So that is, looks like it's happening in Dubai as an example. But it does kind of smell like decoupling from the US legacy financial system a bit.
Yeah, well, I think it makes sense. I mean, if you're in Dubai and you're looking for a way to become a global financial center and to close the gap with the legacy centers, Tokyo or London or wherever, that this is the way to do it. I mean, if you compete in the same way, it's difficult. But if you come at it kind of asymmetrically, I think there's an opportunity there. So I think the risk reward really favors kind of some risk taking from the small to mid-sized kind of players, and then I guess probably less so on the incumbents.
Yeah. But like, when I think about the El Salvador Bitcoin bond that was, not promised, but hinted at for some time. And one of the barriers to that was, this is my understanding of the issue, was that there wasn't a global investment bank that was involved, and therefore for an institutional fund manager to participate in a Bitcoin bond, some global investment bank has to custody the security. Because an investment manager can't custody it themselves. So who's that going to be?
There was
a question mark, right?
There was in fact no investment bank involved, but I can tell you that on the demand side, it was there. The demand was there, full size.
But from institutions, like they may have right? Because they have nowhere to hold it. They know where to hold it.
Yeah.
So
Yeah.
that has to be solved for institutions to get involved. I still,
Yeah.
this is my pet peeve, are these Bitcoin maxis who say the ETF is a distortion of real Bitcoin, and it's not consistent with the ethos. And it's like, let's enter the real world here, where these things called fiduciaries who manage other people's money exist, and a fiduciary is not allowed to hold on to the securities themselves. It's against the law. They have to find a third party to hold on to it for them, because over history the temptation is just too great. Fiduciaries end up stealing their clients' money if they don't entrust it to a third party. And so that's why the ETF was such an unlock, was it allowed the fiduciary to buy the ETF and have someone else custody it.
Sure. Yeah, no, I think that's what kept them out, was there's, mandate and regulatory restrictions that just prevented them from coming in. And that was a great thing for individual investors, is because we could all buy a lot of Bitcoin before, the institutional players could, so that was interesting as well. But, on the other side, I think it is, what's your view on self-custody then? I think it's very important that people be able to take their assets off exchange. I mean, that's one of the benefits, I think, of security tokenization is, with the Liquid network, which is a layer 2 on Bitcoin, it has this whitelisting functionality. You can take securities with an ISIN off the platform, self-custody it, move it to another exchange for arbitrage, trade it peer-to-peer if everybody's on the ecosystem. So I think that seems to me to be like a vastly superior user experience than being locked into a brokerage account that trades 9 to 5.
I agree that self-custody is a big unlock, but not for 100% of my Bitcoin is kind of the way that I'd put it. So I like diversification, and then if you're a fiduciary managing other people's money, the law, you just can't self-custody it according to U.S. laws. Now, the SEC is working on some language to maybe change that a little bit and give investment advisors the ability to custody client assets as long as they have a documented process in place. And we've been doing some of that offshore, and maybe that'll expand into the U.S. But it's still a nice diversification for regulated investment managers to not hold the keys themselves.
And how do you see the ETF space playing out as a whole? I had an opportunity to talk to Eric Balcunas in El Salvador in January or February, and he said he thought that, because the Bitcoin ETF was such a massive success, and then it felt like everybody was kind of struggling to find the follow-up to that. It wasn't clear what that would be, and I think they tried with Ethereum, and there was a couple of others, and he kind of figured that Bitcoin would probably be 80% of that market, and then 20% would be everything else. Do you agree, or what do you see as, what will Wall Street do next to try and make money on Bitcoin? Because I'm sure there's people who have, they saw a number go up and they like that and they'd like to try it again.
I think that the ability to create and redeem ETF shares in kind, so not with cash, but with the coins themselves, is going to be a big unlock for the industry. And it's more relevant for some of the proof of stake coins like Ethereum and Solana, which are often staked. So I definitely think that that was a headwind to Ethereum ETF adoption, and the new leadership at the SEC has been working hard on fixing that. So I believe that we're going to have in-kind creation and redemption by the end of the year. I think we're going to have staked ETFs by the end of the year, and that'll make the ETF experience a lot more attractive. But you tell me what happens to price, and I'll tell you like what Wall Street's going to latch onto. So it's been kind of one way only for Bitcoin dominance. Easy to say, trend is your friend, and that will continue. But if we do get an altcoin season, then something like a Coinbase Top 50 ETF. They have this new index, Coin 50, which is powered by VanEck's market vector indexing subsidiary. Lots of folks want to bring that ETF to market. We still need some clarity from the SEC on the tax implications of staking in order to kind of be fully cleared for launch for a product like that. But that could be very interesting for institutional investors who like diversification and want an S&P 500 of crypto.
Okay. I'd hear diversifying across altcoins. It seems like maybe what could go wrong, right?
It's been a tough market this year, that's for sure.
Yeah. What about Bitcoin dominance? I mean, that's my most hated metric. Do you think that's a good metric to look at? I mean, it's an obviously gamed metric. Why are we still using Bitcoin dominance? Why can't we use Bitcoin volume or something like that? Volume of everything kind of aggregated together. Don't you think that would be a better, more useful metric, a more realistic metric of what's actually happening in the markets?
Well, you want to use price to figure out who's making money. And I think Bitcoin dominance does a good job of illustrating that. Here's one stat for you. The market cap of all crypto tokens ex Bitcoin has not made a new high from November 2021.
Yeah.
But there are 40 million new tokens.
Yeah.
So the average token is obviously down a lot. And that's because of that high inflation, pretty much, right? Like, it's dilution. When you have an inflation rate of 10% plus on some of these altcoins, that requires massive inflows every month just to keep the price flat. So Bitcoin's scarcity is really pronounced and really unique when you think about that statistic: 40 million new tokens, no new high in market cap. So yeah, I disagree with you a little bit. I think Bitcoin dominance is a, interesting and relevant figure.
Well, what I mean is, if you take some tokens, for example, and the tokens aren't actively traded, they're held by insiders. So you can have a token where there's say 10 million with insiders, and there's 100 trading on the market, and then your market capitalization will be market price times by 10,100,000.
Yeah,
and that's not very, and the
static way of looking at it, right? That only exists because there's going to be some inflation rate in the future, which is high, because those tokens don't stay locked up. They don't stay untraded forever. Most of the time, like, a substantial amount come to market as VCs vest, or as the protocol programmatically mints new coins.
Dumps on retail. Yeah. Yeah. But, I've always thought the volume is such a much more realistic metric, because it's people actually trading. I know the best would be US dollar volume, because there's more friction there. I think when you're looking at the stablecoin volume, there's a lot of jiggery pokery, especially on the exchanges that brand themselves as being the most dominant and with the most volume. There's a lot of left hand to right hand. And I think just looking at US dollar volume would probably clear out a lot of that noise as well. But I think it's just because market cap is the easiest thing to calculate. I think people are just kind of lazy. And it's like, we know the total supply of tokens. We just multiply that by the current price. No questions asked. And it's a little bit more difficult to go through and sort through the volume and see what is actually like kind of realistic volume. And then you have to be selective of which exchanges you're including into your kind of calculation. So yeah, I think these are the things that bother me. I think my two kind of triggering things are like Bitcoin market dominance, and then the other one would be how sell side research kind of struggles to like differentiate between Bitcoin and crypto and use those two words as synonyms. But
yeah. I mean, I think that lots of folks look at open interest on Bitcoin futures, Ethereum futures, and in the Bitcoin futures market, the CME is #1 market share. Not true in ETH, but it is true in Bitcoin. So this connection between TradFi markets and Bitcoin markets it's becoming bigger. There's more derivatives, more structured products. That means more traditional broker dealers that are using their balance sheet to make both sides of the market, both spot and now derivatives. And I think that's like more evolved on Bitcoin than on the other coins.
Yeah, I think definitely. I think if you look back at the last 10 years, the Venn diagram has been pretty split between, participants in traditional markets and crypto markets. But that's probably the big trend playing out at the moment, is that diagram is overlapping more, and people are are going back and forth between the two, especially for hedge funds for sure.
Yeah, I saw an incredible stat that the total notional value of derivatives on Bitcoin is something like 5% of the overall Bitcoin market cap, whereas in traditional finance, the total
Yeah, it should
notional
be way
value
more.
of derivatives is like 15x, right? So there's still so much to go in terms of financial products on top of Bitcoin, structured products.
Oh wow, I didn't realize it was still that far behind. That's amazing. That's an amazing stat. That's wild. So what do you think in terms of jurisdiction? So the U.S. I think it looks to be playing out kind of very optimistically. I would say. I don't know what your view of that is.
In terms of the regulation?
In terms of crypto openness to crypto regulation, the end of choke point 2.0, all the kind of changes, the creation of the strategic Bitcoin reserve. All of these things were probably slightly unthinkable just a couple of years ago. So things, and the SEC seeming to be more willing to kind of rethink regulations and how they govern the industry. So all of that seems to be working out fairly well, I think, from my perspective. Would you agree?
I would. I think we still, we want to see this stablecoin bill pass, and the primary objection to it seems to be something like North Korea money laundering, and that the surveillance aspect of the U.S. financial system is bipartisan. You tend to get both parties that are voting to like recertify some of these KYC laws, right? That I think you and I would both argue maybe distort things more than they help things. So it's a bit too early to say that everything on the table is going to be approved. But when I look at what's happening outside the US, that's where I just continue with really high conviction. The number of countries that are mining Bitcoin at the government level, the beginnings of an energy trade, a global energy trade that is partially denominated in Bitcoin, as Russia and China are rumored to be doing. So that's a real giving legitimacy, I think, to using this asset as a settlement currency in global trade. And that's how we get to our upside really long term. If everyone is just hodling the coins and not using them for transactions or leverage, then you wonder if there's really a use case or if we're all just hoarding Pokemon cards.
So what makes you bullish on the kind of global outlook is that the global sovereign adoption is not from the regulatory perspective, it's that countries are actually using it.
Totally. Yeah. I think that we need to use it. I don't think like Jack Dorsey, like we need to use it for coffee, but we need to use it as collateral and as settlement for large transactions. And I think that's starting to happen.
Yeah, I think that what's really interesting about countries like Bhutan too is that there's, we know of a handful of them, but there's probably dozens more that just aren't making much noise about it, but are quietly mining Bitcoin. I'm sure,
we track it. We try to track it pretty carefully. I agree with you. Maybe there are some countries that have not disclosed, but on our numbers, we're up to 9 countries that are using the sovereign balance sheet to mine Bitcoin. That number was 2 in 2021. And last year, the 3 new countries, Ethiopia, Kenya, Argentina, they all have IMF deals, which is, not a coincidence in my opinion, because when you borrow money from the IMF and then you can't pay it back and you got to go to them for an extension, IMF usually says, oh, okay, we'll extend that loan, but in return, you have to do X, Y, and Z in your domestic economic system to make it more market friendly or whatever the conditions are.
I think there's
It
quite a few
often
strings.
involves raising taxes, right? This is what happened to Pakistan just this year. It's like IMF said, yeah, we will extend your loan, but you have to collect taxes on crypto. And Pakistan's like, crypto ain't even legal here, bro. Like, what are we supposed to do? Oh, I guess we'll make it legal. So then they convene this crypto council, and next thing you know, they're allocating 2 gigawatts of power to mine Bitcoin, which is really a de-dollarization play. So, I think that IMF is kind of exacerbating the issue.
Huh, that's interesting because most people, when they think of the IMF and its influence on Bitcoin, they think of what happened in El Salvador, and they think of it as discouraging Bitcoin adoption. But they're actually through their efforts.
I think it opens up negotiating leverage, where you can say, well, we're going to do this on Bitcoin, but we would do even more if you don't give us our loan.
Huh.
Right?
Oh,
Like
that's
El Salvador
interesting.
didn't stop buying Bitcoin. They're still buying a Bitcoin every day. It's like
Yeah.
it's directly flouting the language that's in that IMF deal.
Yeah, I noticed that as well. Yeah, that's very interesting. What? No, that's really interesting. So maybe I want to be respectful of your time here. We're coming up on time. What do you think? What is a question that about Bitcoin that nobody is thinking about now, that nobody's looking at, and probably should be?
Um, I mean, there's the usual kind of long-term issues that eventually need to resolve. Fees as a percentage of Bitcoin mining revenues are at an all-time low. So that raises questions about the long-term issuance schedule. If fees don't pick up, right, would there ever be momentum around some type of tail issuance? We might be decades from really needing to answer that question, but people are going to be thinking about it. Sustainability of Bitcoin miners, looking at the valuation gap between some of these Bitcoin treasuries companies and the Bitcoin miners, starting to look very strange to me. Really pricing in like value destruction at the Bitcoin mining level. So I think that's a question. Impact of quantum, if we get some type of quantum breakthrough that makes some of these old wallets vulnerable, there could be debate around how to address that, whether it's a protocol level improvement or not. So, I mean, those are long-term risks that people are going to be thinking about more. But over the short term, I think it's just proliferation of the view that Bitcoin can be a treasury asset, not only for listed companies, but also for governments. And that story is going to drive the wider adoption over the next 3-4 years.
And do you think Wall Street analysts are looking at any of those issues now, or are they still kind of looking at it as digital gold and maybe have just started to scratch the surface?
I do not think that they are paying much attention to the state of the blockchain itself.
Hmm.
Yeah, they're more thinking about the second order effects. If Bitcoin price is going up, if Bitcoin dominance is going up, what does that mean for the future of Bitcoin price, or who's
Hmm.
going to adopt it? Yeah, sell side not too engaged on the kind of blockchain elements.
So that probably means we're still very early days.
I think so. I think so.
Yeah. All right. Well, that's a good way to kind of wrap it up. All right. Well, thank you, Matt, for your time. I really appreciate it. It's a good conversation.
Thanks, Jesse.